Hello, my name is Jyothi, and I'm grouped with Natalia to work on a case study to determine the best capital structure decision for California Pizza Kitchen. I'll first go over the overview of the company, the challenges and opportunities the restaurant industry is facing. I will then go over the case and the three capital structure alternatives, and finally end with two theories the company should base its decision on. As an overview, California Pizza Kitchen was opened in 1985 in Beverly Hills, California. California Pizza Kitchen derived its revenues from three sources: sales at company owned restaurants, royalties from franchise restaurants, and partnership with craft food to sell CPK branded frozen pizzas in grocery stores. At the end of the second quarter of 2007, the company had 213 locations in 28 states and 15 international franchises. CPK is still very California centric. Approximately 41% of the US stores were in California. The restaurant industry is divided into two main sectors: full service and limited service. Some of the most popular subsectors within full service included casual dining and fine dining, with fast casual and fast food being the two prevalent limited service subsectors. It is projected that the limited service restaurant segment to maintain a 5-year compound annual growth rate of 5.5% compared with 5.1% for the full service restaurant segment. These are some of the issues or challenges the restaurant industry is facing. High gas prices indirectly pushed the commodity prices up. In May 2007, President Bush signed legislation increasing the US minimum wage rate. Then, reduced demand due to high gas prices as consumers look for alternatives to dining out, like purchasing food at grocery store. Deteriorating housing wealth. Intense interest in the industry by activist shareholders. When we look into the opportunities, the longer term outlook for the overall restaurant demand looked much stronger. A study projected that consumers would increase the percentage of their food dollars spent on dining out from 45% in recent years to 53% by 2010. The case happens in July 2007. The financial policy of CPK is very conservative, as it currently holds no debt. Since going public in 2000, CPK management had avoided putting any debt on balance sheet. While other restaurant companies experienced weakening sales and earnings growth, CPK revenues increased more than 16% for the second quarter of 2007. CPK was about to announce near record quarterly profit of over 6 million. Despite the strong performance, industry difficulties were such that CPK's share price had declined 10% from June to July 2007. The recent 10% share price decline seemed to raise question of whether this was an ideal time to repurchase shares and potentially leverage the company's balance sheet with ample borrowings available on its existing line of credit. The available borrowing is 75 million and the line of credit's interest rate was 6.16%. We need to determine which capital structure would best lead CPK to success. Should the company take on debt to repurchase shares, and if so, how much? As you can see in this slide, CPK has to take a decision on three capital structure alternatives shown in the chart. The first one is the current capital structure with no debt. The first alternative we have is 10% debt of the book value of the total capital. Option 2 is 20% debt, and option 3 is 30% debt of the book value of total capital. As you can see, the decision California Pizza management needs to take is capital structure decision. The company needs to base its decision on two theories: optimal capital structure theory and pecking order theory, which we'll see in the next slide. First, based on optimal capital structure theory, CPK will need to weigh the benefits and costs that come from taking leverage to determine a mix of debt and equity that moves the company towards an optimal capital structure. The value of the firm rises and WACC decreases as levering rises, but only up to a certain point where the benefits are still greater than the costs. The benefits CPK will obtain from leveraging through the tax shield will need to be balanced against the cost of agency and financial distress that increases as the level of debt increases. Even though the exact proportion of optimal debt to equity is unknown, CPK can move closer to it, and this will allow the management to both maximize the value of the firm and decrease their weighted average cost of capital. This can better be seen through this graphics. Currently, CPK is 100% equity. Its WACC is equal to the company's cost of equity, positioning themselves at the origin of the horizontal axis, which measures the mix of debt and equity. This implies that cost of capital is higher than the one with debt. The decision faced by managers is what should our debt to equity mix be? That is how much we should move our company from our current point towards the right of this graphics. The tax shield means that since creditors, for example bonds, that can be used to issue debt or paid through interest, which are deducted before taxes, as debt rises, the company is taxed on smaller amount. This makes the after-tax cost of debt cheaper in comparison to the cost of equity, which is paid directly from net income. As you can see, WACC is currently equal to the return on the equity, but when taking leverage, imply that WACC will now be determined by the new mix of capital. As can be seen in the WACC equation and the graphic, taking debt will decrease the return CPK needs to obtain in order to satisfy its investors. To guide them as they choose the mix of debt and equity, managers will also need to consider what its relevant competitors in the industry are doing, at what debt to equity ratio are they operating. Getting a feeling for what other restaurants are doing will contribute to estimate a convenient capital structure, since it is reasonable to assume that industry is operating at certain average and close competitors are operating at certain level of leverage. They do so because it is beneficial, so it would be appropriate to try imitate that while considering the specific characteristics of the firm. Once the company decides how much leverage to take, they will need to consider a second theory, which is signaling or pecking order theory. CPK will need to consider the initial negative signal that issuing debt sends, that money is tight and they don't have enough cash on hands to be able to capitalize with second reading that investors do from it. That even though money is tight in the present, CPK management would not be taking debt unless they are confident that prospects in the future are positive, and thus they are sure that they will be able to generate enough cash to pay the interest and principal of debt. Overall, it is considered that the net of the two signals sent is positive and improves growth expectation of CPK performance looking into the future. Additionally, since money raised with debt will be used to repurchase stock, the signal that this capital structure decision will be sending out is that management believe that currently CPK stock is undervalued and therefore they are willing to buy back stocks at that price. Based on asymmetric information, the investors will then also believe that stock is currently trading at lower price, and this will have a positive effect on the stock's price, increasing it. Based on the pecking order theory, the best source of funding for CPK would be internal financing, but since currently the firm holds no financial slack, the second best source of cash is debt, which is precisely what the firm will be using, so they would be following the pecking order theory of capital appropriately. Thank you.